and following on the dollar, and you could have went dollar short, oil short at the same time pretty much. So you could have went dollar short, oil short. So that gives you at least a hedge trade against that dollar short position, which took place on a 5-minute chart there at 155 London. 155 London. So you can see where that trade was in real price terms. You can see that 155 London is this candle here, and it's that same price level that we traded at. The dollar still very obviously visible in that chart. The supply line in the short term still definitely in play. There's no real massive buy side outlook on this trade just yet. I like the shape of this. I like the shape of that short sell. I like where it was. The volume was okay. It was punchy, but it wasn't too high. And the outcome, well, the outcome $87.60 traded $86.80. So you're looking at around about another $800 short sell into those areas. And that's obviously what we're seeing. Now, the challenge we've got is the higher right-hand hold. The advantage we have is that there was a fast rejection of that high price rather than an acceptance at the high price. And that's always something that you always pay attention to. A fast rejection of something is a very, very strong clue that that is done for. And that should be pretty obvious. If you walk very quickly away from something, nobody's going to walk back towards wherever they came from, right? That's the mass herd psychology. You've seen it in experiments, and even, you remember there was the terrorist phase in likes of France when everybody started to hear a single noise and they all started to run like crazy. You all saw probably videos and news clips and social media clips of people running, and they don't even know what they're running from. They just saw everybody running. So somebody somewhere heard a loud bang or of some description, and they all started to run. In fact, there was a social media clip. Did anybody see it? That there was a group of joggers out. There was a group of joggers from a local kind of sports centre, and I don't know what country and I don't know how long ago, but there was a group of joggers out jogging past a restaurant, and the people in the restaurant saw the joggers jogging past, and they assumed that something had happened, and they all basically all jumped off their tables and started to run because they thought something was going on. And you look at that and you go, what the hell even happened there? You know, so it's just one of those mass psychology things. Well, the markets are very similar in some respects. There's a mass psychology. So if I was, for example, showed you a trade and it comes up like this and it does this, do you think there's any chance the price is going to buy back into that area? Do you think there was any chance the price was going to buy back into that area? Of course there is, because there's an acceptance up there, right? So there's a very good chance price may buy back into that area. But what happens if we see that something like looks like this? The chances of them buying back into that area gets less and less and less, because everybody looks at that and says, what the hell happened up here? What the hell even happened up here, right? So the chances are you're going to get something that does that, and it goes. That lack of acceptance, that lack of something, that lack of any interest in that price, whether it's justified or not justified, doesn't actually make any difference in some respects. What it means is that people simply aren't going to want to go there anytime soon. People aren't going to want to go back into this location, particularly anytime soon. And obviously that's what you start recognizing. So, you know, one of the advantages, so you can see at the bottom edge here, for example, when the price ticked down into this bottom edge here, you can see there was a bit of an acceptance there, wasn't there? There's a bit of acceptance there, and the price retested back into the lows. But then you saw this kind of rejection and acceptance at higher prices, not at lower prices. And that was it, wasn't it? That was it. That's why we kind of suggested in the likes of equities, it has to go above a certain price before it becomes really bullish. Well, there it goes, look. There it goes. So when the price accepts there, comes down here, and then rejects almost instantly, you know that market's gone north, right? You know it's gone north. And that gives you that idea that that market going north is great fun. Easy, nice, buy, trade. Now, obviously, when we hit the high price, the one thing you'll notice is it didn't accept the high price. It immediately rejected. So whilst it was a very, very fast money move, acceptance is down here, which means when the price retests back into that high price, it's more likely that as soon as any selling comes in, because of the speed of the selling that came in the last time, it's going to cause a bit of a panic kind of sell reaction, isn't it? It's going to cause a bit of a panic sell reaction because people remember the last phase of price action. This is something we've touched on in this morning's classroom, this idea of recognizing this morning's price action, recognizing the most recent price action is the most important price action. And recognizing that there was a big seller came in there, it means that it's going to be easier to sell upticks than it is to buy downticks at the same price area for the time being, until something new happens, of course. But obviously this higher acceptance is going to start putting pressure in here, because on a bigger chart that just looks like a double distribution up, which means that there's going to be people still willing to buy into these lower prints in here, for example, and so on. With the dollar down like this, I'm certainly not going to be the guy that's with the dollar down in terms of the line here. I'm not going to be the guy that's buying into this anytime soon. I'm not going to buy into this anytime soon. Okay, so I'm not going to be the buyer that comes in here. I'm certainly more inclined to be the seller at top edges, yeah? Steve, we'll certainly cover order flow today, no problem. We'll look at order flow, and then we'll look at order flow in line with the shape of the markets and where it is in terms of that market structure. And we'll build out from the order flow. But yeah, we can definitely look at some S&P order flow, NASDAQ order flow like. We'll have a look at that this afternoon in the classroom. Cliff on at 87.50. Yeah, I mean, as I said, Cliff, I think the sell is the only trade I like. I mean, I'm not interested in the buy side of this at the moment. 87.50 was the price we sold at pretty much exclusively this morning. So it is a real key price level for us to work with. It was pretty obvious they were going to sweep the stops at 87.50 because there were so many sellers at the 87.50 itself, and they did a good job of a pretty meaty sweep through it. But obviously that's what you're watching. You're watching that fast rejection of the lows. You know it's probably going to sweep. It did sweep. You know it's going to be a relatively meaty sweep because there's so many sellers with stops at that price. And you just wait for it to sweep and then sell it on the way back down again. It's dead easy. A lot of people panic about selling on the way up. They don't have to ever sell on the way up. You can always sell on the way back down again, guys. But this top right double distribution hold at the moment needs to be broken. And it needs to be broken to the downside, otherwise the bulls will get more and more confidence at the moment, Cliff, and they will probably try and take the price back up towards that 88 handle instead of the 87.50s for the next rotation.